I want to introduce you to Corpflow. Corpflow is a very unique and innovative strategy which essentially provides a tax solution for business owners. Corpflow is a more tax-efficient way for owners to access corporate profits on a personal basis. We're going to look at who this strategy is ideal for, how and why it works, and we want to look at the financial benefits. First of all, Corpflow was designed for two specific types of corporations owned by shareholders. First of all, they're Canadian-controlled private corporations. And in situations where we have corporations with consistent high cash flow, for example, a legal practice or a doctor's practice or a high-end accounting practice, these would be corporations owned by shareholders that have consistently high cash flow. We also want to look at corporations with high amounts of retained earnings. In a lot of cases in Canada where you have a shareholder who has a fairly active and very profitable business, shareholders leave funds in their corporations as retained earnings. Why do they do this? Because they don't want to pay the tax that's associated when funds are paid out as dividends. So corporate shareholders who have very profitable businesses and have funds that they don't need to meet their current living standards leave funds in retained earnings, and Corpflow provides a very, very attractive strategy to liberate these retained earnings, which is what a lot of shareholders are ultimately looking for. Some of the concepts in Corpflow are not new. Essentially, we're using life insurance contracts to achieve personal tax efficiencies. This was first introduced in the mid-1990s. We know what has worked in the past, and we know what hasn't worked in the past. We know that the Department of Finance and the CRA are familiar with this type of a structure, and we know that the tax-exempt status of life insurance is not in question. And what do we mean by the tax-exempt status of life insurance? Essentially, when you have a life insurance policy, there are two basic components. One is the actual death benefit, which comes at a cost, and that is the cost of insurance. A secondary feature in particularly permanent life insurance contracts is the ability to overfund the contract. In other words, deposit funds in excess of what's required to pay for the death benefit. These excess contributions can be invested in a variety of different investment vehicles inside a life insurance policy. And the growth inside the policy, in other words, the investment yields that are inside a life insurance policy, stay fully tax sheltered up to a certain amount, and that's called the MTAR line. That's what we refer to as the tax exempt status. In other words, you're allowed to put in a certain amount of funds into a policy for an investment purpose, and those funds can grow fully tax sheltered. And what makes this particular strategy effective is a new life insurance policy. It's called Universal Life, which essentially provides for a death benefit and also a savings component. Now, BMO has introduced a investment option called GMIA, the Guaranteed Market Index Account. And what this does is provide the investor an opportunity to participate in the upside of the TSX 60 or in a U.S. equity account. Both are available. Provides an upside to the market without any downside risk. Now that is very, very unique in itself, because very seldom, or if ever, are you allowed to participate in the equity markets without any downside risk. Well, that's exactly how this contract works with BMO. And I'm not getting into mechanics as to how BMO provides this guarantee, but rest assured, they're a very, very large organization in Canada, and they have mechanisms in place that are too detailed to go into here, but they do provide a guarantee that in the event of a downside or a negative return in the investment, there would be no downside risk to the investor. And in this type of a contract, the GMIA, BMO has set up again, an investment that's tied to the TSX 60. At the end of each year, BMO looks at the investments that are made inside the contract, and the first 3% of the yield of the TSX 60 belongs to BMO. So that's their profit margin, and that essentially gives them the funds required to provide the guarantee for the lack of downside risk. And that's called a hurdle rate. So there's a 3% hurdle rate attached to this type of investment inside the policy. After that, the net profits that are yielded inside the GMIA are split according to a participation index. Now, BMO did some back testing on this type of initiative going back from 2003 to 2012, a 10-year period. They launched this mid-2013, so it's been in existence for about a year and a half. And from back testing, we can see that the participation rate, which is the amount of profit that the individual receives after the 3% hurdle rate has been taken by BMO, averages somewhere around 62%. Now that participation rate is determined by two variables. One, the prevailing interest rates, and two, the cost of an option contract. And each year when you invest inside the policy, BMO buys an option contract on the TSX 60. And in 1 year that option contract expires, and if the market has increased, then the option contract would yield a profit. If the market has decreased, then the investment wouldn't yield anything for that particular year. So the cost of that option contract is variable by volatility in the market. So if the markets are very, very volatile, it costs more to buy the option contracts. If the markets are less volatile, the option contract costs less. So right now we're in an environment where we have interest rates that are fairly low and have been fairly low and stable for quite a while. And we have fairly low volatility in the market. And over time, that has yielded an average of about 62% participation rate. So let's have a look at a couple of years and see how this program works. First of all, let's look at a year when the market had a very, very robust earnings period. So let's 2005. The market went up 27.36%. And in that year, 3% off the top would have been taken by BMO, so there would have been 24% left over. And of that 24%, it is split. In this case, 85% would have gone to the investor inside the life insurance policy, and 15% would remain with BMO. So overall, a crediting of 20.71% was provided inside the insurance contract for that year. Let's take a year when we saw some negative impacts in the market, and in 2008 was a very good year. We saw the market lost nearly 40%. In fact, it lost 37.76%. And because of this contract, there's no downside risk. So the interest crediting to the policy that year was zero. Now you might say zero is not a great return, but when the markets dropped 40% and you didn't lose anything, that's a very, very attractive yield inside the policy. So you can see here that in this particular example, we started out with 100,000, and we can see the fund growing over time, and never does it go down. It only ever goes up. So once a year has elapsed and the option has expired and interest is credited for that particular year, it locks in that amount of money and it can never go down. And graphically, that looks something like this. The dark blue line is the actual market itself. And we can see that the market goes up and down and up and down, and it always has during the course of time, and we call that volatility. Generally, investors don't like volatility. Everyone wants the upside, no one wants the downside. But look at the GMIA, the green line. It provides a partial upside when the markets are going up, but when the markets go down, the GMIA is level. When the markets go up, the GMIA participates, never getting as much as the market itself, but when the market drops, like we saw in 2008, the GMIA was flat. And over time, we end up with a return that's not that far off of the market as a whole, but without any of the volatility or very, very little volatility. So this is a very, very unique type of insurance contract. It's really the engine behind this Corpflow strategy. So in this particular example, all of the funds that grow inside this policy, because of the tax-exempt nature of life insurance, grow fully tax-deferred, and those funds stay inside the policy to be used at some point in the future. Now I want to look at a particular insurance policy, and I run an example of a 40-year-old male with a premium deposit of $120,000 a year for 10 years. Now this policy is a Bank of Montreal policy with a GMIA account, so the funds that are invested in the GMIA and they would yield a return. I ran this proposal with a 6% growth rate, which is pretty consistent with the long-term average in the back testing that BMO did. So with any insurance policy, we have a death benefit. In this case, the death benefit it started out at $3.5 million. At the end of year one, it was $3.7 million. And we can see that it continues to grow over time. And generally, it grows at a fairly robust rate. This amount of money would be paid out tax-free to the beneficiary of this policy whenever that, or should that ever occur. Or when that ever occurs. It's going to occur, just not exactly when. We also have a policy that has a cash value. So in this case, the cash value starts off low, and then it starts to accelerate over time. At the end of year 10, we have a total amount of deposits, total accumulated deposits of $1.2 million, $120,000 a year for 10 years. And we have a cash value of $1.4 million. At the end of 10 years, there are no further premiums due, but we still have an accumulation of cash value inside the policy, along with the corresponding death benefit. Now these funds all grow tax-deferred. There's no tax levied against this policy while it stays in force. And at some point down the road, the shareholder would like to use these funds to generate an income. And this is where Corpflow, it's really primary design. It's designed to provide a benefit to the shareholder at some point in the future. So I've run a spreadsheet here that shows exactly that. And there's a lot of columns on this spreadsheet. I'm just going to highlight a few of them here. I have this spreadsheet broken down into 3 parts. On the left-hand side, it shows the income of the shareholder and the tax rate. On the far right-hand side, I show what happens inside the corporation. So let's assume, in this case, we're assuming that the corporation is going to pay $120,000 a year for 10 years into a policy, which is in the center portion. We've also assumed that the corporation, if they didn't buy the insurance policy, would put $120,000 a year into a retained earning account of the corporation. I've assumed that the corporation's retained earnings accounts is going to grow by 5%. Earnings inside a corporation are not tax deferred. There is tax levied inside the corporation. So the retained earnings would be subject to tax, but would still grow. The cash value and death benefit from the insurance policy were simply transferred over from the previous ledger that I showed. And at some point in the future, in this case I showed at age 60, I showed what the retained earnings account of the corporation could generate after tax, assuming we drew an income from the age 60 till 90. Now these amounts are variable, these timelines are variable, they can be lump sums, but I just made an assumption that we would draw an equal amount of funds over a 30-year period. Now inside the corporation, by the time the individual is 60 and they put $120,000 a year into retained earnings, there's about $1.9 million in retained earnings. Assuming you could dividend that out over time and we continued to grow the balance of the retained earnings, an income of $88,000 could be generated for 30 years after tax. A life insurance policy with the amount of cash that this one has in it at age 60, it's about $2.75 million. A policy can be used very advantageously. The shareholder would simply take the policy to a bank, and in this case it could be BMO, Harris Bank, which is their private bank. Manulife Bank also has strategies that are acceptable to them, and they would take a life insurance policy such as this, take it as collateral for a bank loan. So the shareholder would simply pledge the policy as collateral and ask the bank to start advancing funds based on the value of that contract and the continuing growth inside the policy. The policy continues to grow even though we're starting to use essentially the policy as collateral for a loan. And in this case, we can see that from age 60 until age 90, the same time period, the policy would provide $168,218 of after-tax income to the shareholder, which is virtually double that can be achieved by using the same amount that would have been earned inside the deferred earnings account of the corporation. So in year one, we took $167,000 out as a loan. Interest was added on. The following year, another $167,000 was taken out. Interest was added on. And we can see that it generates $168,000 a year for 20 years. And the loan is accumulating over here. Bank loan balance. So you might ask, how does that loan ever get paid off? Well, let's assume the shareholder dies at age 90. Now at age 90, the death benefit of the policy has grown from $3.5 million, it's 3.7 at the end of year one, to $13 million. The loan at that time would have grown from $167,000 to $10,698,000. When the shareholder dies, the tax-free death benefit of $13.4 million would pay off the loan, and the balance of approximately just under $3 million would be paid to the estate of the shareholder. So at any time, there's always more money available through the death benefit than there is in loan balance. So in other words, there's never a situation where the shareholder is going to have to dip into his own pocket to pay this loan back. It's always being funded by the values, cash values inside the life insurance policy. And as a net result, we can see that this scenario, by putting money into a life insurance contract and having the funds grow fully tax deferred, generates approximately, in this case, double the income that could be generated if the shareholder had simply put the funds in the retained earnings account. So this is a very, very attractive strategy. As I said before, this has been around for about 20 years. And what really makes this work exceptionally well is the fact that this insurance policy with the GMAA account has a fairly predictable growth rate, and the fact that there's never any downside risk because of BMO's guarantee means that the funds that are inside the policy will always be inside the policy. So that becomes a very, very attractive and useful asset for the corporation, and as you can see, it provides a much better benefit than if the corporation had just simply kept the money inside and paid it out down the road as a dividend. Now, the last component of Corpflow involves something through Section 148.7 of the Tax Act, and this allows a owner of an insurance policy, in this case a shareholder, to buy an insurance policy and transfer it to his or her corporation for its fair market value. Now, because of the benefits or the structure of the BMO insurance policy with its guarantees and its essentially as its principal protection of cash, it yields a very, very high valuation. So the strategy here is for the shareholder to purchase the universal life policy in their own name, pay 1 month's premium. We then have the policy valued by an independent actuary, and a valuation is then bestowed upon the policy, that policy can then be transferred to the corporation, the shareholder's corporation, and the shareholder can receive the fair market value of the policy. Now, in this particular example, this particular life insurance policy example that I've shown here, where we have $120,000 a year going in for 10 years, the valuation of this policy, even though it's from the very, very beginning and from the original onset, should the shareholder purchase the policy and pay as little as 1 month's premium, the value of this contract is somewhere around $1 to $1.5 million. So let's assume it's $1.2 million. If we take the midpoint, the shareholder could sell this policy to their corporation under Section 148.7 of the Tax Act and receive $1.2 million from the corporation tax-free. So this becomes a very, very advantageous position for a shareholder, because they would essentially be owed $1.2 million by their corporation, and that payment is made through, if the company has sufficient retained earnings, it can make that payment in one lump sum and simply pay the shareholder $1.2 million in this case. If the company doesn't have a balance of retained earnings but has high income, a promissory note can be issued from the corporation to the shareholder, and that promissory note can be retired over time with the profits of the corporation. So you can see that this last component, the valuation component, really, really makes this Corpflow strategy extremely advantageous in allowing the shareholder to access after-tax profits or retained earnings immediately. So let's summarize. We have an insurance policy, which is the foundation of the Corpflow strategy. Funds are deposited into an insurance policy. They grow to fully tax sheltered inside the contract. And in this particular example, we're using a Bank of Montreal Universal Life contract with the guaranteed market investment account option, which provides upside growth tied to the TSX 60 without any downside risk whatsoever. All of the growth inside the policy grows tax sheltered until it's utilized at some point in the future by the shareholder. In this case, we're going to use the policy as collateral for a bank loan. Bank loans, loan installments, of course, are not taxable to the shareholder, and the policy provides the collateral for the tax-free loan installments to the shareholder, and those installments run for whenever the shareholder, however the shareholder would like to take them, 10, 20, 30 years, can be taken in lump sums. We usually like to show an average payment period. In this case, we showed it for 30 years, and it provides a very, very attractive high after-tax yield to the shareholder. And of course, the last component is the valuation of the insurance policy, and under Section 148.7 of the Tax Act, it enables or permits a shareholder to transfer a life insurance policy to their corporation for its fair market value. And just as an aside, the fair market value is determined by an actuary. An actuary is an independent professional that specializes in valuation of various assets. In this case, an insurance policy has various benefits and advantageous components to it that yield a valuation. And that value can be paid to the shareholder immediately if the company has sufficient retained earnings, or paid out over time if the company has high cash flow and high profits. And that is essentially Corpflow. Thank you for listening, and we'll talk soon.